Welcome back to Rich Dad Stockcast with Andy Tanner. Today we're going to talk about something I think that everybody needs to know before they can even start investing, and that is, what do you do when good stocks go bad? Like, that's just right. That's probably everyone's fear when they're stock investing.
It's gonna happen. It's gonna happen.
Things go bad. I can tell you, my first marriage, it went terrible, and I was afraid to get married again. But I did, and it's great. So maybe we need to learn from Andy how to overcome our fear, not of marriage, but of stock investing here. So first of all, that's Andy Tanner. He's our Rich Dad wealth expert and stock expert. And Andy, I want to start this off with, what does that mean? Good stocks go bad. Does it mean? Well, actually, Andy, let me take it one step back. And I try to do this every show because I think this is the most valuable part of the show. Sorry, no offense.
Yeah.
But Andy is actually going to, he hasn't even done it yet, but he's going to make a special web class just on this topic so that he can expand on this and he can really give you the education he wants to give that 30 minutes doesn't really allow.
Generally, I've got so many web classes recorded that almost any time we do a topic, I can say, hey, if you want to learn more, check here. But this one's special, and I think it's timely. And I've probably got something in my database, but it's probably too old. So when you gave the title, "When Good Stocks Go Bad, What Do You Do?" What a valuable opportunity for financial education, because it's going to happen. So. It's why I hate the moniker. You always say, "Oh, Rich Dad expert." I hate being an expert because I'm wrong so much. I'm like, how can I be an expert if I'm wrong so much? But that's part of the game, right? That's part of the game, is being wrong. And I don't know if you're wrong, things just change, right?
Okay. At the same time, I think when you teach your 4 pillars class, when I went through that, you're talking about fundamentals, technical, cash flow, but you doubled down on your risk management because you can just feel that topic is it's part of your makeup. Like I've seen you get passionate about it so that people don't get hurt when they're investing. Like you can feel the emotion and the energy just about risk management and what to do when a good stock goes bad.
It is the premier skill of any investor, regardless of asset class, the ability to manage risk. There's a risk and reward that's just, I don't know if the word is inextricably, is that a word? They're intertwined. They are, you cannot separate them two. You have risk and reward. And I don't even know if maybe I shouldn't say I'm wrong so much. Sometimes things just change, right? I mean, maybe you have your first marriage and, well, it wasn't wrong on the day you got married. Things just changed, right?
Right.
And so first thing you do is you know what an exit strategy is. So you did well, right? You did well. Exit strategy. When it's not going well, leave. But there's any number of things we can do. But let's decide what it means to have a good stock go bad.
Thank you. That was really what I wanted to start with. Really for my own education, what you mean by that.
Well, I'll tell you what it isn't. And this is where so many people get wiped out or killed or whatever. A good stock going bad has nothing to do with the stock price. A good stock going bad, most people judge whether the stock is good or bad based on the stock price. And that is a huge, huge mistake. And by the way, if people want to argue with that, let them argue with that. Well, blah, blah, blah. I can hear the people in their little voices in their heads. They've already decided what they think they know, and that's fine. But I'm telling you,
that's why we have a comment section right there, everybody. You want to argue with
stock
Andy,
price? Yeah, the stock price is not the way you judge that. What stock ownership is business ownership. I love the way Warren Buffett puts it. He says, "I don't pick stocks, I own businesses." That is such a healthy approach. So when you say, does good stocks go bad? How about let's swap that and say when a good business goes bad. And that has nothing to do with the price. You can have an awful business with a high price, and you can have a great business with a low price. I'll give you an example. During COVID, you could have bought Ford Motor Company, I think for $7 or $4, I think it was, maybe 3, I can't remember. During COVID, you could have bought Exxon Mobil for high 30s probably. In COVID, you could have bought Dow Chemical for I think like $20. In COVID, most of the companies had their lowest prices in long time, and they were awesome companies. Absolutely, the biggest sale, the COVID sale was. I mean, I just hope we have another one. I just hope we have another one because a low price could absolutely be a bargain. It is not a sign of the company doing poorly. It could be that people are just getting freaking emotional out there, and you have a bargain. So that's in mass.
You're saying a good stock going bad. In this case, isn't the stock went bad? The price went bad because the market went bad.
No, the price went good because it's on sale.
But because of the market.
Good. Yeah, because the market sentiment went bad.
Okay.
Right? The market sentiment went bad, but the prices were fantastic. It's all about what you get for that price value. So the first thing you don't do is you don't make that decision based on price. You make that decision based on, okay, what happened in the company? Because I've had some stocks I've bought where both happened. The price went down and the company kind of changed. I'm like, okay, so for example, and it doesn't necessarily mean I'm bad. Sometimes you just go for something that's good because you found something better, right? Some guys do that with their marriage. Right? It's not the first one went bad. It's just the second one that came along was better. It's like, honey, I met someone, right? But that's my fear all the time because I know Marcy can get a BBD. The BBD, the bigger, better deal. I know it's constantly a threat with me. She can upgrade at any moment, man. And if she did, I don't know that I could blame her. But anyway, so what do? Well, here's some basic risk management stuff. There's a huge difference between diversification and position size. Huge difference. Warren Buffett's got a lot of eggs in the Apple basket right now, man. He really does. If you look at the amount of money he has in stocks, about half of it's in Apple right now, and about 80% of it's in 5 or 6 stocks. I don't like the idea the diversification is just spreading your money around, just spreading it around haphazardly. Position sizing is saying, look, I like this investment. I'm not buying it just to spread money around. I like the company, but I'm not going to put everything I have in it. And so the first thing is position sizing. That I think is as important as anything else is to not get too big in one, especially if you're a beginner. Now, if you're Warren Buffett, it's a little bit different. But if you're new, you probably don't have the savvy he does to build up positions as large as he has. So the first defense is hopefully if the company goes bad, you don't have too much money in it. Now, let's talk more about this, though. What happens when a good house goes bad? What happens when a good car goes bad? And what happens when a good body goes bad? So let's say, you have a really healthy body and, my wife is a fitness nut, absolutely insane. Get a little lump here and there, go get it checked out. You got a mammogram. Next thing you got a fight, right? You got a big fight. Same thing happened to me when I was 34, right? Got a little lump somewhere, you get it checked out. And now you got a fight, right? You got a big fight on your hands. So one of the blessings that you have, at least from a financial standpoint, is you have insurance. You have insurance. If your car goes bad because it hits a tree, insurance. If your car goes bad because it gets hit by someone else, a drunk driver, you have insurance. If your house catches fire, you have insurance. Robert wrote a book called The Unfair Advantage. And he was kind to let me contribute a little bit in a chapter or two in that book. And he kind of passes the mic to me or the pen or whatever. He says, hey, I'm going to let Andy give his viewpoint on this. And so he let me write a small amount. He said, Andy, what's the big difference between professionals and amateurs? I go, well, there's 2. Number 1, excuse me, number one is amateurs, they tend to look at capital gain. They tend to want to look at the price of things going up and down. But the second one is how they deal with loss, and it's insurance. Most investors hold it down to the bottom and the company dies and gets killed, but others will have insurance. So you can actually insure your stocks. Now, if you were to look at 401k people in my home country, the United States, and in Canada, it's an RSP, and in Australia, it's a super, and in Japan, it's they actually stole the name. It's a 401k. Most 401k owners have their money in two places, their house and their 401k. I would imagine there's about 141 million housing units in the United States. And we had last year, I think, probably 300,000 structural fires. So some of those commercials, some of them residential. So you're probably looking at about a 0.01% chance that your house is going to burn down. About one in 1,000, 1 in 10,000, something like that. So people say, well, there's not a real chance my house is going to burn down. In fact, no one listening to this thinks their house is going to burn down today, and probably no one's is, right? You get 20,000 people watching a thing, their house is burning down this year. But if you take the nation, a lot of people can have their house burned down. So what does the bank say about that? They say that's a large enough risk that we won't give you a mortgage if you don't have insurance. The banks care about it. The banks are professional investors. They're going to say, you better have insurance or we will not give you this money. We will not loan you money without insurance. That should scream to people that it's insured. Well, the second place people have a lot of money, they put a lot of money in their residence, calling it an asset, and they put a lot of their money in their 401k. With the statistics I just gave you on housing burning down, what do you think is more likely to burn down this year, your house or your 401k?
Scary, but your 401k.
I would say it's much more volatile place with much more risk, zero insurance. These people will watch it burn. They're not looking at it as business ownership, zero risk, watching it burn. So, maybe when we come back, I know we'll probably due for a break. Maybe we can talk a little bit about what that looks like and the countermeasures you can have when something good turns bad. Because when your fire happens, you got insurance. When your 401k burns down, what do they got? They got nothing. So it's an important thing when good stocks go bad to have insurance. We can talk a little bit about that. I don't know. Are we due for a break? I feel like
yep, we are due for a break. So when we get back, we'll talk about when good stocks go bad and how to insure them.
Yeah,
I also have one other thing I want to ask you, because once again, you did hit my greed button, and I want to make sure that I satisfy that need, because I think you said something in there that is the way I would like to try to make money, and I want you to correct me if I'm wrong.
You're always greedy, and I love it. I'll take it.
All right. Hey, I got to pay an ex-wife here, Jeez.
You got bills to pay, man.
I got bills to pay. All right. When we get back, we'll handle both of those.
Awesome. Welcome
back to Rich Dad Stockcast with Andy Tanner, and we made a promise that we were going to talk about what to do when a good stock goes bad. And again, Andy's passion and risk management, so I think it has real value. And then at the same time, I think I heard an opportunity in there to get incredibly filthy rich. I'm just kidding, Andy. Totally kidding. Just trying to make
filthy, stinking, vulgar rich.
Yeah. Just trying to get your blood pressure up there. Although no strokes on camera, that'd be horrible. So let's go first with the first promise and talking about when a good stock goes bad, and Andy, how you can insure it and protect yourself.
So, I have a great team at the Cashflow Academy, and our resident risk manager, his name is Corey Halliday, and he earned a Series 4 license where he became what's called an options principal. And he worked for a Wall Street firm for a number of years. He's got hundreds of floor traders trading just risky, crazy stuff. He's got to manage all that. And, the way you do that primarily is with options. And it's funny because people say, well, options are risky. Actually, options are very much like insurance, because what they do is they bring certainty to uncertainty. In other words, what an option does, it gives you a choice to buy something or sell something at the price you want. And so if you don't know what prices you want to buy and sell at, and the stocks are all over the place, boom, you can use that contract to say, no, I'm going to protect myself with this. So that's the form of insurance is options. We use those as insurance. And there's so many other things we can do called hedging. We could do, I'm going to throw out some fancy jargon, but you can beta weight your whole portfolio. You could say that's how he would have done it, as an options principle, is you say, what's the aggregate risk here relative to a big move in the S&P? Let's get some opposing contracts. Maybe you short some E-mini futures to get yourself neutralized, what we call delta neutral. So there's a number of jargony, fancy things we can do, but they basically, use derivatives, use futures, use options to hedge against drops, kind of like a seesaw. If I feel it's going to go down on this side, well, I'm going to put a little more weight on this side to balance things out and all this. Let's talk about two things, though, before we talk about your opportunity to get, filthy, stinking, vulgar rich. Our producer brought up a great point. She said, what happens when there's a fundamental change in the company? And I think that's a real good insight. For example, they get mad. Steve Jobs is kind of an evil genius, nutty guy, kind of arrogant. I liked him. And
Apple.
Yeah, they kick him, they fire him, they kick him out of his own company. And I've seen that happen. I've got a friend of mine that had that happen to him. They kicked him out of his own company because, entrepreneurs and leaders, they're they just have their driven personalities. They're A types, right? They mow people over. So they kick Jobs out of the company. What does that do to Apple? I mean, that takes the heart and soul out of the thing, right?
Yeah.
Or perhaps here's another thing, legislative risk. Let's say that you are in Nevada, or Colorado is where it started. Let's say you're in Colorado and there's a legislative change that says, hey, we're going to start doing weed here, man. We're going to get some high grade. I feel like if we were like Joe Rogan, we could light some up right here. That's what he does. Maybe that's why his podcast does so well, is he's smoking weed. I've never smoked weed in my life, and I didn't, and not only didn't inhale, I didn't light either. But anyway, it's kind of funny. What if Colorado? So someone opens a big business and they put an investment, they borrow money, and they're selling cannabis and oils and all this stuff. And all of a sudden, 10 years down the road, the DOT and the people in Colorado, they say, well, the statistics show that accidents are up. We've got problems, and we've come out with new research that says this stuff isn't good or whatever. I don't know. I'm not a doctor. But the scenario is they say, hey, now it's illegal. Okay, what is that? What happens to that business now? Right? So there's legislative risk. Someone is cranking out AI and they say, hey, we're a little worried about where AI might go. We're going to put some restrictions on it. Or you're working on the human genome and they say, we're getting a little too powerful. We're going to put restrictions on it, right? So the very thing you're working on could be buried legislatively, right? So there's geographic risk. There's the orange crop goes bad in Florida because they have a freeze. I mean, there's a million different things that can affect a business fundamentally, not technically in price, but fundamentally. So we keep an eye on those. Warren Buffett will pivot. He said, I'm not going to have airlines anymore, after COVID. And he says, I'm just too big of a risk for me now. So he got rid of his airlines. The banking industry changes. You look at the mark-to-market risk when you can't get loans and you have savings coming in, but no loans going out. So you're losing money. What do? You buy government bonds at zero interest almost, 0.1 interest. Then all of a sudden, whoosh, you got Silicon Valley Bank. You got a mark-to-market problem. You've got people wanting their money back now. You've got to sell your, low yield bonds in a high yield environment. You're done. So all these different things can affect, and you've got to look at it from the point of a business owner, not price, as I said in the earlier segment. So if Jobs leaves and you don't like that, it might be time to change and you might take a little loss. But don't panic with price. Kraft Heinz, perfect example. It's at $71 where Buffett, helps the merger between Kraft and Heinz. He picks it up at 71. They have some impairment costs, meaning that they value their Oscar Mayer brand at too high. They just said this brand is worth a lot. And the SEC said, nah, come on. And they kind of self-reported on it. They said, we probably made it too high. Next thing you know, their price goes from 70 to 30. Buffett doesn't sell. Why? Because that's not a fundamental flaw in the company. Does that make sense?
Yeah.
That they're still selling ketchup. Their debt didn't change. Everything was basically the same. They just had to take their asset down, and they make that look like a loss in expense, but it really wasn't a fundamental change to the business. So if you want to know when a good stock goes bad, be a business owner, not a price watcher, if that makes sense. So if Steve Jobs leaves, you might say, you know what? I feel as the heart and soul of that company. I think I'm going to pull, right? Or you might say, hey, maybe they just got rid of the biggest problem in that business. Maybe they skyrocket, right?
Right.
It could go either way. And that's part of fundamental analysis, experience, position sizing. Put some options on there, see how it goes.
Let's talk about that. You mentioned market. You mentioned leadership change. COVID, we talked about before.
Yeah.
Legal problems. And you have basically the same insurance for all those different problems?
Yeah, this is what's interesting. If you were to list the risks, geographic risk, legislative risk, systemic risk of like a systemic problem, you could go down and list all the different risks that you could come up with. Interest rate risk, right? All these risks are there. But you know what risk I'm most afraid of? The one that I haven't thought of.
It's fair.
I mean, it's 90 degrees. Like people, all these conspiracy theorists, well, they knew 9/11 was going to happen. No one knew 9/11 was going to happen. And you woke up that morning and everyone remembers that. It's crazy. Like these guys did this nutty thing, right? No one sees that coming. So it's that type of stuff. What's beautiful is insurance covers all that stuff, right? I mean, did your fire start because someone was smoking in bed? Did the fire start because of lightning? Did the fire start faulty wiring? Were kids playing with matches in the neighbors? Whatever, wildfire, whatever it was, fire's fire. If you have fire insurance, it's covering it, right?
Yep.
So all of that, while you want to make decisions based on the business, it's the price that will take money out of your pocket, right? So you separate those two and you insure the price, but you make judgments on the business. If you're unsure, hedge it up a little bit. And understand COVID was not a flaw in businesses, right? That was a difference in price.
Right.
Awesome businesses. I mean, incredible sale, incredible businesses. But the panic of people, the price dropped because of the panic of the people, not because the businesses were flawed or had bad leadership or bad legislation, right? And so that's a great learning experience for people. Now let's talk about getting rich.
Wait. I just want to be clear about a couple things here. Tell me if I got this right. You're kind of offering two levels of risk management. One is not to put all your eggs in one basket. Don't put all your money into one investment, one stock. And obviously don't spend more than you're willing to risk. But the second one is options. And one thing I'd like to clarify is you mentioned Ford. Ford was, I think you said $30, and then it dropped to...
It wasn't 30. It was probably in the teens and dropped to like maybe 7 or 4 or something like that.
Okay, so what are you doing with options that makes it insurance?
So what to get jargony, and I hate the jargon, so we'll have to do, when we make the companion video in the class, I'll make sure I define that jargon better than we have time for here. But you have something called a put option, which gives you the right to sell. So let's say that a stock is $50 and I suspect there might be problems. I might say, you know what, I'm going to spend 50 cents or $1 or $1.50 or whatever. I'm going to say, I'm really afraid that this is going to go from like 50 to 40 or 50 to 30 because there might be a fundamental flaw in the business.
Right.
But I don't want to sell it yet because I don't know for sure. Okay, well, maybe I take a little hit and I say, hey, I'll throw $1.50 at this and I'll buy some insurance that gives me the right to sell at 50. And someone says, okay, I'll do that. And this is what Burry's doing, right? This is exactly what he's doing, right, with the NASDAQ right now. At least we think he is.
Right.
All those headlines that they say he's shorting the market. No, he isn't. He's buying puts. He says, look, I'm buying insurance on the market Same thing he did in The Big Short. He created insurance for CDOs that says, look, I have the right or the choice or the option to sell them high, even if they go down low. So let's say, and Mark Cuban made a brilliant move. He's probably the guy I would use for this example. Is Mark Cuban sells his company broadcast.com to Yahoo for stock. So now he's got $5.7 billion in Yahoo stock. It's trading at 100 a share.
Right.
He's nervous. He thinks it's going up, or he wanted cash instead of stock, but he's nervous about a tech bubble. He's nervous about it. He says, well, I don't know how and I don't know when, but I think this be worth insuring. So maybe he says, I want the right to sell these shares at $100. So he makes a contract where he can sell them at $100. Then the stock went to 5. It was bad. Yahoo went to 5, went from 100 to 5. That's a $95 difference, right? What that means is those contracts are now worth $95 per share. Wow. Because a person could theoretically have the right to buy them low, and they also have the right to sell them high. They have the option to sell high. So it guarantees your selling price. So that contract explodes in value. Shoot, he could keep his $5 stock. It's the contract he would sell because it's got what we call intrinsic value. So that's kind of the bet Burry's making right now. Is he's saying, look, I think we're going to have a contraction. I think we're going to have a recession. I think that he's smarter than me, I would suppose, but I think AI is going to kind of drive tech and keep a floor on it. But who knows? He might know something I don't. but that's how that works, and you can do that opportunistically. Buffett's done it opportunistically.
All right, yeah. Let's talk about the opportunities here. I keep hearing, the COVID or jobs, leaving, and the stocks dip.
Yeah.
Why isn't the answer, obviously, Ford dipped to what, $2? Why isn't it all around Ford?
7 or 4? I shouldn't quote stuff because then people in the comments will freak out. They'll go look it up and say, who's this? But you can see in COVID, there's a massive drop in everything from Ford to Exxon to McDonald's to whatever, right? They all dropped.
Well, you can't see. At that point, it was too late to put insurance, but as a qualified investor,
really, I don't know. Look, when it started falling, I bought insurance. I'll give you an example. When it started falling, I had my eye on ExxonMobil at 50, 55 anyway, because that's where support was. And as I was looking it down, as it hitting that, I go, I'm going to buy it right there. So I bought it on the way down, and at COVID. And as soon as COVID hit, I bought some puts. I says, I want the right to sell this at the price I bought it for. And it dropped down, and those contracts exploded with value. I kept the stock, but I sold the option that I bought, and I collected that insurance money. So you can. Let me tell you some of them that I made and some of them that I missed. The one that I'm most angry about that I missed was GM, because here's the thing. It is very hard to see the up. It's easier to see the down, I think. Right. I'll give you an example. Steve Jobs and who is it, Wozniak or whoever, they're in their garage selling their VW to get components for their first circuit board or whatever. There's 8 zillion nerds that dropped out that are in their garage doing that. There's 1 million of them, and you can't see any of them because they're in their garage. You could not see Steve Jobs. He was tiny, he was microscopic, right? So you can't see small things that are going big, but you can see big things that might go small. The one that I missed, and I should just shorted the hell out of this, and I didn't, is I'm watching the debate between Obama and Romney in the presidential debates, right? And one of the things they're arguing about is Romney says they need to declare bankruptcy. Their non-funded liabilities of pensions are way too big. They're going to fail. We need to restructure those promises, and GM needs to go bankrupt. And Obama's saying, no, we don't need it. We should, hang in there, whatever. So they're arguing about this. Well, the reason Romney's saying this, he's a business guy. He's looking at the balance sheet saying, they're not making it, man. I've turned a lot of companies around in my day at Bain. And you're not turning this one around without a bankruptcy. So you could see it coming, the threat. that might have been a time to be opportunistic, where you see this huge balance sheet, this huge liability in there. You're like, I should short the heck out of this. One that I did get before it went crazy on Reddit was I got the other one I missed was Blockbuster Video. I should have seen that coming a mile away. They're not pivoting. Netflix is coming out. The idea of this is called obsolescence risk. Sarah talks about leadership changes. How about obsolescence? Where you look at Blockbusters, I mean, my kids laughed. They're like, wait. You used to go to a store to get movies. You used to go to a store. You'd take the DVD home from the store, and then you'd bring it back and pay your late fee. Are you kidding me? Yeah, that's how it went. You hung out in Blockbuster. You were kind of weird. That guy's in Blockbuster a lot.
Right.
So that was a model we should have seen coming. So when I saw GameStop with the same model, I was like, games are going to be downloaded too. We're not going to go and do the Blockbuster thing. So I actually bought some puts on GameStop. This is before the Reddit thing blew up. It was about a year and a half before that. And so that was a nice one. That was a nice call. So you can do this opportunistically. Now, I didn't get filthy, stinking, vulgar rich on that play. Why? Position size, right? We made a nice amount of money, but it isn't like, Andy just is going to go out and buy a 40-foot yacht now, because it's not how it was. Position sizing. So I do like to have a small amount of opportunistic stuff like that, and it's fun to know how to do it. But the bigger issue would be protection. I'll give you a little
wait. You cannot give any more info. You got to make people click on that button down there in the description.
One more info.
If they want the details. All right,
one more info that's fun. So there's this movie. I just love this movie. It's not for the kiddies because it's got some naughty stuff in it. But if you watch the TNT version, you're okay. And TBS. And it's on every Christmas. It's not really a Christmas movie, but it's on every Christmas because it's set during Christmas time. It's Trading Places. Dan Aykroyd's the Santa, and he's getting set up by the Dukes, right? I love that movie because it's about finance. It's about commodities brokers and frozen concentrated orange juice and pork bellies. But there's a lot of great financial lessons in there. So there's this scene in Trading Places where they've got Eddie Murphy, right? Billy Ray Valentine. And Billy Ray has just got this new apartment that they're going to provide for him. And they've got him in a nice suit, and Aykroyd's out of the picture. And, they've got his little butler there. Can't remember his name, but who's the name of the butler? I can't remember now. Whoever it is. God, it escapes me. Anyway, so they're showing him his house. And Murphy obviously doesn't believe any of this. He's like, this got to be a scam. He's like, oh, this happens to me every week.
Right.
And he says, so you're telling me this is mine? And he grabs a vase. Very nice vase. He says, oh, so this is my vase. I can play Metal Like Lemon with this vase. And he starts playing around with the vase, and he drops the vase, and it shatters. And he looks at it, and he looks at the Dukes, and he goes, that was fake, right? And that vase was a fake, correct? And the Dukes say, I believe we paid $30,000 for it. But then Mortimer says, but I believe we estimated its value with the insurance company at $50,000. So we just made like 20 grand or whatever it was, 36,000 to 50, 14, whatever it was.
Right.
And he says, see that, Mortimer? He's already made us, this much money. And so then they, he says, want me to break something else? No. And that's the joke. But that's kind of like a put option, is you can agree to sell it at whatever you want, and you just buy. And Cuban Mark Cuban had an interview. This is 1,000 years old. I don't know why I remember it. It was 60 Minutes. And I think it was Steve Croft probably that was interviewing. And Steve goes, I can't remember the name of the butler, but I can remember this, right?
It's Coleman. It's Coleman. Our
Coleman, that's it. Coleman.
Yep.
Coleman,
Sarah
that's it. Coleman. Thank you. She's Googling in the background. So anyway, I forgot it was now we're talking about Coleman. So
it's Cuban on 60 Minutes.
Yeah, so Cuban's on 60 Minutes, and he said, And so Croft goes, so what was it like to get 5.7 billion? He goes, oh, it was surreal. It was incredible. He goes, but didn't Yahoo stock fall? And he goes, well, yeah, but I was covered. You know, I had a hedge, and I was more than covered, which told me that he actually overinsured the way he worded it. Now, Steve Croft you can tell in the interview, Croft has no idea what he's talking about. There's no follow-up question. He's just like, oh, he was covered. You know, he didn't ask why. He didn't ask how. Croft is a reporter. He doesn't know finance, right?
Right.
The way Cuban worded it, he says, I had insurance and then some. And when he said, and then some, that's the vase, right? He overinsured. He probably made a ton of money opportunistically by saying I was covered and then some. I had insurance coverage and then some. And that little and then some caught my ear. Like, okay, he probably bought a few more puts than he needed, perhaps opportunistic. So I don't do the opportunistic thing much. I feel like I can achieve my goals just through cash flow and protection. But for those that care to do the Michael Burry thing, if you feel very passionate, or better said, you have analytics that suggest, as Burry did, you know, here's these CDOs, these subprime mortgages have a date to where they're going to adjust the rate. This is the date where it should be. It made sense, right? And maybe he got lucky, or maybe he was smart. There might have been a ton of guys before him or after him that had different dates, and he just happened to have the right date. Could have been. Sure. I don't know if he was, but he was brilliant in that at least he had exposure to it and saw an opportunity to the downside. And I'll tell you, if you get in those positions when the downside comes, you know, the bulls go up the stairs and the bears jump out the window. I mean, they're straight down. So opportunistically, there are some opportunities. So when good stocks go bad, better said, when a good business goes bad, position size, understand insurance. And if you're a really good technical analyst or really good, fundamental analyst, and you're good with timing, you know, maybe you short some stuff. Soros has made a lot of money shorting stuff. You know, Burry made a ton of money shorting stuff. So,
well, let's end it there, because you just made it where my mind opened up. Where not only is it risk management with insurance, but a chance of
there is an opportunity. I would be remiss to not confess that there are opportunistic positions when things go bad. No question about it.
Well, Andy, once again, I learned something new, and thank you so much.
All right. Awesome, man.
All right. See you next week.
Cool.
All right. Bye.
Podcast is a presentation of Rich Dad Media Network.